So I was just finishing up coding a particular trading strategy, and I wanted to talk about one fundamental topic in trading that I think a lot of people overlook or don't explain really in the correct way when you apply it to systematic trading. Systematic trading primarily is where we're looking at data and we're using data to verify our trading decisions and our trading strategies. So we're not doing anything on intuition or guessing or feelings or anything like that. We're just focusing on pure data. This brings me to the topic of this video, which is the only thing that matters in trading is alpha. That's fundamentally it, and this is otherwise known as your edge. Now, to give you a bit of background on myself, I'm Manir, also known as Ghost Talk Trades on Twitter. I've been trading for over 5 years now, and I run a portfolio of futures algorithmic strategies. So those are just strategies that are automated entry and exits on the futures markets. That's ES, NQ, CL, etc. And I've been able to make over 6 figures over that time. Now let's continue with this strain of thought. So the real edge comes from doing useful things that others find unattractive. The key word here is unattractive. Most of the time, real edge comes from solving a pain or taking a pain or being able to withstand a pain that others are not able to. If you're not 100% sure what I mean, well, let me get into 3 main types of trading edges. Now there are others and variances of each one of these, and there's a bit of nuances, but I'm just going to give you the key summaries that you actually need to know so that you can understand where real edge comes from. So let's get into the first one. The first one is pure arbitrage. So the pure arbitrage, let me just actually zoom in here for you so it can be a bit more focused. The pure arbitrage is the easiest to understand and one of the hardest to capture. Now, why do I say it's the hardest to capture? Well, to give you a recap of what an arbitrage is, I'm going to give you a very simplified example of back in the day on what you could do with crypto. So let's say we had 2 exchanges. We had one exchange that was red and we had one exchange that was green. Let's say the red exchange was selling BTC for $100 less than the green exchange. That means you could buy it on this particular exchange and then sell it on the green exchange, and you'd make $100 on that trade. Obviously, if there's commissions and fees, but let's just say they don't exist for this particular example. First off, the advantage of an edge like this is it's incredibly obvious, right? So if you just have multiple exchanges listed up and you had a dashboard for all the prices of different assets, you can clearly see if one is mispriced to the other. Now, these actually still do appear nowadays, but they're more often around new listings of coins, and when they are newly listed on different either exchanges, especially like decentralized exchanges, there can be a pricing mismatch where you could actually take advantage of that, but I'm going to get into why this is actually very difficult to capture. First off, competition can be fierce. That also is led into because it's a very obvious edge, right? You really just have to look at 2 prices on 2 different exchanges and you can, calculate if there's potentially money to be made there. But also this gets into the second part, is this normally only exists on newer markets. So back in the day when crypto was very new, there were a lot of these trades you could actually make, and people that were kind of in the know or already knew this sort of knowledge by then when they were actually trading crypto markets, they could exploit this and actually make a decent amount of money. Nowadays, unless you're finding a new exchange or a new market, where this sort of exists, most of these aren't very apparent unless they are on very low liquidity. Now, low liquidity means you just can't push that much size through them. So let's say you had a market that was only trading 100K daily volume. It's going to be very difficult to actually push enough size through that without moving the price, closing that arbitrage, meaning that unless you're trading a very small account, you're not actually going to make much P&L. You might make a decent amount of return percentage-wise on that very small account, but in relative terms of that actual P&L, it's not going to be that much money. Now, also, because competition is fierce and it's quite an obvious edge, most of the time these don't last for that long. Sometimes they do, but that's normally when there are very low liquidity, so no one's actually just bidding on these at all, so it's going to be very difficult to exploit anyway because you'll probably just move the price with your very small amount of size. That's why a lot of these opportunities can look like free money on paper, but when you actually go down and try and execute these, fundamentally they're not going to work as well as you really hoped. Now, I will say smarter people than me have been able to exploit these. You can do other things such as arbitraging funding rates. You can do the difference between spot and perp, all those sort of things on crypto. I'm not a crypto mainly focused, but I know a lot of these particular situations or edges can actually exist there right now because it's still a bit more of an inefficient market compared to like ES and NQ. You're never going to find, or at least to my knowledge, you're not going to find an arbitrage on ES compared to different exchanges. They're just way too liquid, way too efficient. You're not going to find really one, at least I've never had. Now that's the first type. So I think this is a fundamentally really easy to understand. It's basically just 2 prices that don't match and you're able to arbitrage the difference of those. Now the second type is statistical arbitrage. So this is finding relative mispricings. So this normally involves identifying relationships between similar assets. So let's give you a really easy example. This example doesn't actually work nowadays. You can sort of do it, but it doesn't really actually make much money. Let's just say ES and NQ. So they have a particular relationship and a particular correlation that we're used to, right? So let's say if ES normally goes up, NQ normally goes up with it, right? And what you're trying to do here is you're trying to spot when these relationships get temporally distorted, meaning that they don't exist for that particular amount of time, or they move away from the normal correlation, where you can then exploit these, and your trading profits is going to be when things return to normal. So let's just kind of visually see this. So let's say ES and NQ were both, I'm going to put NQ in red, were both always trending upwards together, but for one particular time, ES starts going higher and NQ for some reason starts going lower at that same time. So that could be an opportunity there where you can be betting on both sides basically and waiting for them to revert back to how they would normally trade, right? So you can make a bit of money with that. I would say these are not as common. They are quite also tricky to model out correctly. And a lot of the times the return there isn't actually that wide. But this can be applied onto multiple assets, obviously. So the fundamental concept can still work depending on just what instruments you kind of find that actually work really well and provide a high return with this. Now, as you can already probably tell, if you're more used to watching general trading content, let's say about support and resistance, this is a very different approach, and this is very fundamentally based on data. We aren't really going off, feelings or, our intuition over the amount of years we've been trading. While I personally have no hate towards those approaches, I know many amazing discretionary traders. I also know that to be an amazing discretionary trader is a lot harder than to exploit data and inefficiencies in markets. At least that's in my opinion. Now, number 3 is probably the most reliable edge and what a lot of people are trading, but they may actually not know what it's called or what the idea is around. And this is risk premium harvesting. So the idea here is that risky assets must offer a higher expected return than safe assets or no one would buy them. So let's say there was an asset, right, where you were going to make the same return as the risk-free rate, but you could lose 50% of your money. Why would you ever take that particular, why would you ever put money on that particular asset? I would just put money into the risk-free rate, which would be like, bonds or something very safe like that. And that's how I'm going to make my money. I wouldn't, put any over there. So fundamentally, this means that if there are going to be more risky assets, they should have a higher upside or expected returns that you could get because of this extra risk that's involved. To give you a real life example and something that can be just easily visualized, let's consider 2 games. Number 1, I give you $100, and that's it. I just give you $100. And 2 is we flip a coin. Heads, you lose $100, so you have to pay me $100. And tails, you win $300, and I'm having to pay you that. Most people are going to choose number 1, despite having a higher expected value with number 2. Why? The core concept here is risk aversion. Most humans have a preference for actually avoiding risk. Now, if you're a trader, maybe that's not as true for us, but fundamentally, most people are more risk averse than trying to take on risks. And this preference creates risk premiums across markets. If anyone is watching that's a full-time quant or anything like that, this is a simplified overview, so I hope you forgive any nuances that I'm missing out on this. It's mainly just to give a train of thought of these sort of 3 main types that I wish I had known earlier in my trading. A lot of my first year trading, I was really focused on things that weren't fundamentally an edge. Like I was just looking at my intuition on support and resistance, where fundamentally I had no experience. I was in my first year of trading. It wasn't like I'd been watching markets for 10 years or anything like that. So this is a way that you can actually look at data and use data to get an edge without having to have 10 years of experience in your own trading. The key insight I want you to take away from this is edge exists where things, and let me just spell this out, suck. There's always got to be a pain around an edge. In a lot of ways in trading, you're getting paid to be able to withstand a certain pain. And that's applicable to so many different scenarios. Let's just say in the small caps world. So in the small caps world, this is where it's any stock really that's below 500 to maybe a billion market cap, and it's stocks that are gapping up on the day. So this is the previous close level here, and this is the opens. That means it's gone up X amount of percentage, and we think that these are mispriced, so we're trying to revert them, meaning that we're shorting them, and then they hopefully go down, or they have trended down over many years before. Now, I won't get into the specifics of some people saying this edge is being eroded because there are a lot more people doing it, but I will get into the topic of why there is this edge to even exist in the first place. First is because there's even a mispricing, right? A lot of these stocks don't deserve to be up that much, and there's a mispricing there that we are fundamentally arbitraging in some essence because we think there's an overreaction based on whatever news or whatever has come out around the stock. Two, there's a lot of risks in small caps that, in my fundamental opinion, is why it hasn't been fully arbitraged out. Those risks include halts and other high volatility. If you were to put large size in small caps, which I do know a couple traders that do, but it's incredibly difficult because if you are stuck in a halt with large size, you could take a catastrophic loss that just wouldn't ever really happen if you were trading ES or you're trading Apple or things like that. Obviously, if you oversized by a lot in Apple and it moved against you, you could take a hefty loss, but there's no way you'd have a halt and then for it to move up, 500%, blowing up your whole account. That's just not going to happen in Apple. So those are some fundamental risks you're being paid to withstand to be able to get that edge from small caps. Obviously, there's a lot of other things that go into that, but I think that's just one of the fundamental aspects, at least for this particular example. Other things to think about is you're providing liquidity when others don't. You're taking on risks where others avoid those. You're operating in constrained or difficult markets, and you're doing operational work others don't want to handle. These are the most common examples of why you're getting paid for a certain edge and why there's actually an edge there anyway. Granted, this is a simplified overview, but many of the edges I've observed and traded align very closely with these three main types. And if I'm ever working with someone to backtest or automate the particular strategy, I'm constantly thinking about which sort of type is this, because then I can have a better understanding of what my expectation should be when backtesting it or automating it. Now let's get into what this actually means for you. I know this has been a lot of kind of theory / talking over it, but let me go into some kind of key tips that at least have helped me. Now, the first one I want to cover is you want to chase simplicity, not complexity. Good strategies are often very conceptually simple and robust and not complicated and fragile. The more you try and add, whether that be parameters or reasons why this particular strategy should work, the more likely it will actually fail when you actually take it to live markets. They become extremely fragile, and that's why a lot of this channel is all around backtesting and robustness testing, as the key skill in systematic trading is being able to model out your particular strategies and understand them. Next, you want to focus on the why. Understand who's trading at bad prices and why you can extract an edge from them. A lot of trading is trading against other people. You're always trading against someone that may have even more knowledge than you, or you're exploiting or taking a pain that they cannot withstand. So you have to understand what sort of bad prices are you trading at and why you're even able to extract that edge from them. Next, you want to accept the suck. Now, I could have worded that way better, but this fundamentally goes over that the more unpleasant aspects a strategy has, the more likely it contains a real edge. Now, that isn't like a full truth. I'm not saying that every strategy has to be completely terrible, like huge volatility and everything, for it to actually have an edge. That isn't true. But if you're having a very high return, that is going to be more correlated to that you're having to take on some sort of risk or some sort of headache that other people are not wanting to take on. This also applies in a very simple level that why do we make money as traders most of the time? It's because we have to withstand drawdowns. Compared to a risk-free rate, right, where you're guaranteed to make whatever 2.5%, 5% over the year, where you're getting paid every single day X amount of percentage, in trading, you're not getting paid every day. You're not, winning every day. And that's also a fundamental reason why you're going to be paid X amount of money for that return if you're able to be profitable over the year, because you were able to withstand that drawdown. And lastly, trade small and verify. Always start with small bets. I always personally like to start by trading an edge with a small amount of size, see if it actually works, and then also be able to then go back and backtest it thoroughly and model it out. Because if you're trying to push extra size, that's where you really need to know if that strategy holds up. And you also need to be able to simulate the assumptions you're making when pushing bigger size on that particular strategy. And that goes into you need to spend time verifying an edge for actual proper backtesting. A lot of times, most strategies don't actually have any fundamental edge. Most of them also, I will say, are risk premium harvesting. Nothing wrong with that. I make a decent amount of money by doing, mostly these. I'd say maybe 60-70% is kind of risk premium harvesting for the most part, at least in futures, because to find an actual alpha in futures is very difficult. It is one of the most efficient markets. That doesn't mean that there's nowhere to make money. It just means, if someone's saying you could make 100% next month trading futures, that's very difficult to do unless you are leveraging a lot. And then what does that go back to? You're taking on more risk that others probably wouldn't by using that leverage. And that's why if you can even get that return, it is because of the leverage itself, not because your strategy was so good that you were able to make 100%. Now, this was a bit of a ramble, but I hope it maybe helped you in any way. These are just three main types that I wanted to cover to give you a really good idea of what edge actually looks like in the markets. And as a shameless plug, if you are interested in actually backtesting, I'm going to leave a link to my backtesting bootcamp in the top of the description. It has a free starter guide if you just want to get some free value without paying anything. Otherwise, you can obviously join if you would like to as well. But apart from that, I hope this